Right now, if you look at the markets, uh, every day, retail investors are just scrambling. I mean, they are frantically trying to diversify into like AI tokens and pixelated JPEGs, basically hoping for a lottery win.
Oh, absolutely. It's pure speculation for the most part.
Right, but the wealthiest entities on Earth, we're talking mega corporations and sovereign governments, they are doing the exact opposite of that. They're blindly, aggressively consolidating into just a single asset.
Which is wild, right? Because it completely flips traditional investment wisdom on its head. You are always taught to spread your risk.
Yeah, build a balanced portfolio,
Yeah.
diversify.
Exactly. But when you look at the upper echelons of this specific market, that whole playbook is just getting thrown directly into the fire.
And that massive disconnect is exactly what we are digging into for you today. So welcome to the deep dive. We've got an incredibly fascinating source on the table today. It's an April 2026 editorial from normiecrypto.com, and it's titled The Bitcoin Maxi, Why the Big Dogs Aren't Sharing.
It is such a good read. The premise is just, it's fascinating.
It really is.
Yeah.
The author points out that while everyday folks, who the piece affectionately calls normies, are out there chasing a 100x gain on, the latest dog coin.
Right, the meme coins.
Yeah, exactly. While they're doing that, the largest balance sheets in the world are executing this highly coordinated, single-minded land grab.
And to really understand the sheer scale of this wealth transfer, you have to kind of look past the internet culture. I mean, forget the laser eye memes on social media.
Yeah, the stuff that gets all the attention.
Exactly. Because what we're actually watching is game theory and Austrian economics playing out in real time on a massive global scale.
Okay, let's unpack this. We need to get inside the head of the so-called Bitcoin Maximalist, right, to figure out what is driving this calculated psychology.
Which is a very specific mindset.
Very. And we also need to look at the hard data of who is actually hoarding the global supply as of April 2026. Because, spoiler alert for you listening, the leaderboard has drastically changed.
It has, but like you said, the psychology is really the foundation of everything they do. You cannot understand the acquisition strategy without first understanding the economic worldview.
Right.
And for a maximalist, it all starts with this core concept called low time preference.
Which is a term that gets thrown around a lot in Austrian economic circles, right?
Right.
But how does it actually govern their behavior in the actual market?
Well, time preference is essentially how you value present consumption against future security. So in a traditional fiat system like the US dollar, the structure itself incentivizes a high time preference.
Because your money is losing value.
Exactly. You are implicitly encouraged to spend or take massive risks today because the purchasing power of your money is constantly being diluted by central bank printing.
Right, you have to run on a treadmill just to stay in place.
Precisely. But maximalists operate on an extremely low time preference. They look at this hard-capped asset with a mathematically enforced limit of exactly 21 million units, and they realize that saving actually rewards them over a long enough timeline.
So they view fiat currency as like a melting ice cube.
Yes, the melting ice cube analogy is perfect. They are entirely willing to delay today's gratification to stack an asset that won't melt.
It's like, think of fiat currency like trying to save water in a leaky bucket, right?
Yeah.
The longer you hold it, the more you lose.
Yeah, that's exactly it.
Whereas Bitcoin is perceived by its followers as this mathematically sealed vault. I mean, it's like a massive multiplayer online game where the developers can just type a cheat code and spawn infinite gold. If you know the developers are doing that, your in-game gold is losing value by the second.
So you're going to spend it as fast as you can.
Right. But Bitcoin is a game where the source code for spawning gold was permanently deleted, the server was locked, and every single player has a live copy of the ledger to ensure nobody cheats.
That is the perfect mechanism to describe it. And that locked server ethos brings us to another core pillar of their psychology, which is a fundamental distrust of human authority.
Oh, yeah. The article really hammered this point.
They operate entirely on the principle of rules without rulers.
Because humans are fallible. I mean, every time a human has a lever they can pull in a financial system, they eventually pull it for their own benefit.
Right. That is exactly the Maxi argument. If you look at legacy finance, it requires an immense web of trust. You are trusting the Federal Reserve to manage interest rates without triggering a recession.
Which, good luck.
Right. And you are trusting corporate boards not to misallocate treasury funds. You're trusting clearinghouses to actually settle your trades. A maximalist looks at that entire web and sees nothing but attack vectors and counterparty risk.
They just see vulnerabilities everywhere.
Exactly. They prefer to place their trust in transparent consensus algorithms because code executes identically every single time. Math doesn't have a political agenda, and it cannot be lobbied to change the rules.
Which perfectly explains the intense tribalism we see in the space. The editorial points this out really well, I think.
Oh, the tribalism is intense.
Yeah, because when you're actively fighting the inertia of the entire global legacy financial system, it's no longer just a portfolio allocation. It becomes a core identity.
Absolutely. It's a belief system.
Right. They see themselves as defending a mathematically pure system against a broken, debt-based system. That shared adversary binds them together in a way you just do not see with, like, standard index fund investors. You don't see S&P 500 maximalists acting like this.
No, you definitely don't. And if you view every single human intervention in a financial system as a fatal flaw, it forces you to drastically shrink your investment universe. This deep distrust is what leads to their absolute strictest rule regarding exactly what they are willing to own.
Which is Bitcoin and absolutely nothing else, period.
Exactly. Zero exception.
But I have to push back on this rigidity a little bit.
Yeah.
If I look at the broader cryptocurrency ecosystem today, I see a dashboard of thousands of networks. You have chains doing parallel processing, zero-knowledge proofs, complex automated market makers, native yield generation.
Right. There is a ton of tech out there.
So isn't a deliberate lack of features a glaring vulnerability in technology? Why completely ignore the innovation happening everywhere else?
What's fascinating here is that, to a maximalist, turning a blockchain into a Swiss Army knife is a catastrophic error.
Really? A catastrophic error?
Yes, because complexity is the enemy of security. When the ultimate goal is to build a sovereign digital vault designed to store trillions of dollars in global wealth, you do not want a highly complex, constantly changing code base.
I guess that makes sense. More code means more bugs.
Exactly. Every time you add a new smart contract capability or try to increase the block size to speed up transactions, you are introducing a potential bug or a new attack vector for hackers.
So they view, like, Turing completeness or advanced programmability on the base layer as a bug, not a feature. They actually want the base layer to be incredibly boring.
Utterly boring and defensively calcified. They believe the base layer has exactly one job, which is to perfectly secure the transfer and storage of value without going down, ever.
So no high-speed apps on the base layer.
Right. If you want high-speed microtransactions or complex decentralized finance apps, Maxes believe that scaling must happen in layered solutions built on top of the base protocol. That way you aren't compromising the foundation itself.
Oh, like the Lightning Network.
Exactly like the Lightning Network.
Okay, so you handle the millions of everyday high-speed transactions on layer 2 so that layer 1 remains pristine. It's almost like layer 1 is the Supreme Court, right? Settling the massive final disputes, and layer 2 is the local coffee shop where you're buying a latte.
That structural separation is key to their philosophy. But, their rejection of altcoins isn't just about code complexity. It also comes down to origin.
Origin.
Yeah, the source highlights this concept of Bitcoin's immaculate conception.
Oh, right. Because when Satoshi Nakamoto launched the network, they eventually just walked away. They vanished.
Which is completely unheard of in tech.
Yeah, there is no CEO you can subpoena. There is no corporate headquarters a government can raid. There was no pre-mine, where a group of founders hoarded a massive chunk of the supply before opening it to the public, and there was absolutely no initial coin offering to raise venture capital.
It was launched as a neutral discovery. It's more akin to discovering a new element on the periodic table than launching a Silicon Valley tech startup.
That's a great way to put it.
And when you compare that to the thousands of altcoins on the market, the contrast is stark. Almost every other network has a known leadership team, a marketing foundation, or venture capital backers.
Which, to a maxi, makes them look like unregistered securities.
Instantly. If there is a leadership team, there is a vulnerability to human greed or regulatory coercion.
And this naturally bleeds into the economic concept of a natural monopoly, right?
Yes. The natural monopoly of money is crucial to understanding why they think holding anything else is just completely irrational. Maximalists believe that liquidity and network security naturally pool into one dominant standard. It's the concept of path dependence and network effects.
Right, like how the entire internet basically settled on TCP/IP as the base communication protocol.
Precisely. The internet didn't adopt 50 different base protocols. It gravitated to one because once developers start building on a single foundation, it creates this inescapable gravitational pull.
Right. Liquidity begets liquidity.
And security begets security. The maximalist argument is that money works the exact same way. Once a protocol like Bitcoin hits critical mass with the most computing power securing it and the deepest global liquidity, trying to launch a competing quote-unquote better coin is like trying to launch a better internet.
You just can't do it. The network effect has already walled you out.
Exactly.
Well, here's where it gets really interesting. Because they've established this absolute belief that there is only one viable digital asset class, it creates a frantic mathematical race to acquire a specific amount of it. The editorial dives into the psychology of the Trung 1 Million Club.
Oh, this mathematical reality drives an unbelievable amount of market behavior right now.
Because the protocol mathematically enforces that there will never be more than 21 million Bitcoins, the scarcity is absolute. It's not like gold.
Right, where a massive price spike might suddenly incentivize mining an asteroid or opening a new deep-sea mine.
Exactly. With Bitcoin, if you manage to acquire exactly 1.0 Bitcoin, you are mathematically guaranteed to own 1/21 millionth of the total global supply forever. It cannot be diluted by a board of directors issuing new shares.
And when you map that absolute scarcity against a global population of roughly 8 billion people, the psychological hook is incredibly potent.
It's an elite club.
It really is. Owning just one whole coin secures a highly exclusive, mathematically walled-off position in global wealth, assuming, of course, the thesis plays out and it becomes the dominant world reserve asset.
Which explains the frantic culture of stacking sats. Retail investors know the window to grab a whole coin is closing, so they are aggressively sweeping up Satoshis, the smallest fractions of a Bitcoin.
Just trying to build their way to 1.0 before they are priced out forever.
Yeah. But when we look at the April 2026 data provided in the article, the reality is that the average normie is no longer just competing against other retail investors. They are up against sovereign wealth and megacorporations.
The playing field has entirely transformed over the last few years. We've moved from retail hobbyists to a high-stakes institutional land grab.
And the leaderboard of the editorial is just staggering.
It really puts it in perspective.
At the top, you obviously have the wallets attributed to Satoshi Nakamoto holding about 1.1 million Bitcoin. Then you have the major exchanges, like Coinbase, holding around 976,000. But then, and this is crazy, we zoom in on the number 3 spot, the company Strategy, formerly MicroStrategy,
Right.
on April 20, 2026, they officially surpassed the BlackRock ETF to become the largest corporate holder with 815,061 Bitcoin.
It is a historic concentration of a bearer asset on a single corporate balance sheet.
And I have to throw a massive flag on the play here, because Strategy's playbook sounds completely unhinged.
It does sound extreme to traditional analysts, yeah.
I mean, they are actively issuing stock and taking on massive amounts of corporate debt, literally borrowing fiat currency specifically to buy more Bitcoin. But wait, if Bitcoin crashes 50%, which it notoriously does, a highly leveraged company goes underwater.
That's the traditional fear, yes.
You can't pay back dollar-denominated debt with a philosophical belief in Austrian economics. Using convertible senior notes to buy an incredibly volatile digital asset seems like a reckless gamble for a publicly traded company.
I get that. But if we connect this to the bigger picture and view it through the lens of that exact same low time preference we discussed earlier, their treasury management strategy actually has a stark internal logic.
How so?
Well, Strategy isn't executing a short-term trade. They aren't trying to time the market to make a quick dollar on a quarterly earnings report. They view Bitcoin as a one-way lifeboat.
Oh, so they are intentionally arbitraging the melting ice cubes.
Yes, exactly. They are utilizing the structural flaws of the fiat system to extract hard assets.
Wow.
By borrowing fiat at fixed, relatively low interest rates, they are taking on a liability that is mathematically guaranteed to devalue over time due to inflation. They take that melting liability and immediately convert it into an appreciating, mathematically capped asset.
That's kind of brilliant.
Their logic is that if Bitcoin is fundamentally the hardest money ever engineered, you never sell it to buy back into worse money. You just use the fiat system's own leverage against it to keep acquiring digital real estate. Whales do not view this as a tech stock.
Right.
They view it as pristine property in cyberspace.
And it isn't just rogue corporations playing this game anymore. Nation-states are quietly and sometimes very loudly doing the exact same thing.
Oh, the sovereign level is where it gets really crazy.
Yeah, the April 2026 data shows that the United States and China currently hold over 500,000 Bitcoin combined. Now, historically, a lot of that came from law enforcement seizures, like the Silk Road busts, right?
Yes, mostly criminal asset forfeitures.
And they used to just auction it off. But
Okay.
the editorial points out that governments are now actually keeping it on their balance sheets.
It's a fundamental shift in state-level game theory.
The source details this growing political movement in the U.S. to legally classify and hold these accumulated assets as a strategic Bitcoin reserve.
Hmm.
And I want to pause here, just be perfectly clear for you listening. We are maintaining total political neutrality on this. We aren't taking sides or endorsing these policies.
Absolutely. We are strictly maintaining political neutrality here, just reporting the political movements detailed in the source material as a matter of data.
Exactly. But looking at this purely from a data perspective, the mere discussion of a superpower absorbing the supply permanently alters the math for everyone else.
Oh, without a doubt. Once a sovereign nation treats it as a strategic reserve asset, the geopolitical implications force other nations to evaluate their own lack of exposure. You simply can't afford to be left behind if your rival is accumulating.
Which we are already seeing play out globally.
Yeah.
El Salvador has an ongoing public program of buying 1 Bitcoin every single day.
Right.
The Kingdom of Bhutan is utilizing its massive state-owned hydropower resources to mine it directly. So you have this incredible collision course, right? Corporations are issuing debt to buy it, sovereign nations are hoarding it or mining it with stranded energy, and at the exact same time, the actual protocol is producing less and less of it.
This is the underlying mechanics of the supply shock, and it is entirely rooted in the 2024 halving.
Right, because every 4 years, the code dictates that the amount of new Bitcoin rewarded to the miners is cut directly in half.
Exactly. And since that 2024 halving, only 450 new Bitcoins are generated by the network per day total.
Just 450.
But the data from the editorial shows that institutional buying, between the ETFs, the corporate treasuries, and sovereign funds, is happening at 2.8 times the rate of that newly mined supply.
That's completely unsustainable for the price to stay flat.
It is. The incoming demand is a fire hose, and the available new supply is a trickle.
Which perfectly explains the massive behavioral difference between a whale and a retail investor during a market correction. The article notes that when the price dumps 10%, retail investors panic, right? They sell their fractions and run back to fiat currency for perceived safety.
They get shaken out.
Yeah.
Yeah.
But the whale's strategy, the sovereign funds, they don't blink. They understand the macro math, so they see a 10% drop as a temporary discount on the scarcest asset in the world, and they just aggressively add to their stacks.
Because a corporate whale operating on maxi principles does not care what the fiat exchange rate is next Tuesday.
Right, they're looking decades ahead.
They care about the macro supply dynamic in 2030 or 2040. They know the absolute limit is 21 million, and they know the daily issuance is constantly shrinking.
So what does this all mean? When we look back at the original premise of the editorial, the psychology of a Bitcoin maxi is clearly not just internet trolling or blind stubbornness.
Not at all.
It is an intellectual purity that is deeply rooted in game theory, extreme mathematical scarcity, and an unyielding distrust of centralized human systems. To them, everything else, the complex altcoins, the digital art NFTs, the inflationary fiat dollars, is just pure noise distracting you from the signal.
The core takeaway here for you, the listener, whether you agree with the maximalist worldview or not, is the sheer power of focus.
Focus, yeah.
The source strongly suggests that success in this rapidly evolving space might not require holding a diversified portfolio of 50 different experimental crypto projects.
Right.
It might simply require the discipline and low time preference to hold on to the single base layer asset that the largest institutions and governments in the world are fighting to absorb.
That's a compelling argument.
It is. But this raises an important question, something for you to mull over after we sign off today. If the entire underlying ethos of Bitcoin is rules without rulers, this beautiful decentralized dream of separating money from state and corporate control, what happens to that revolutionary dream when a very small handful of legacy corporations, Wall Street ETFs, and global superpowers end up permanently owning the vast majority of the 21 million tower supply?
Wow.
Does the ultimate decentralized asset ironically lead us right back to a hyper-centralized concentration of wealth?
That is a heavy, heavy question to sit with. I mean, if you've got Wall Street and sovereign governments permanently taking up all the seats at the roulette table, what happens to the retail player who's just trying to buy a single chip?
It's a great question.
We want to thank you so much for joining us and bringing such a fascinating source to the table today. Keep digging, keep asking these hard questions, and stay curious. We'll catch you next time on The Deep Dive.